In this section, we will explore the topic of lending to subprime borrowers. Subprime lending is a term that involves lenders providing loans to borrowers deemed subprime. Subprime borrowers have a greater perceived risk of default, such as those who have a history of loan delinquency or default, those with a recorded bankruptcy, or those with limited debt experience. Subprime loans are usually classified as those where the borrower has a credit score below a certain level, such as a credit score below 620. Generally, the term subprime can be applied to non-conforming loans. As you may remember, these loans do not meet conforming or government loan guidelines, generally due to one of many factors, including the credit profile of the borrower, debt-to-income ratio of the borrower, or the quality of the documentation provided with the loan. Subprime mortgage loans are higher risk loans in that they are made to borrowers unable to qualify under traditional, more stringent criteria due to a limited or blemished credit history. Subprime borrowers are generally defined as individuals with limited income or having FICO credit scores below 620 on a scale that ranges from 300 to 850. A FICO is a credit scoring system developed by the Fair Isaac Corporation. FICO is a publicly traded corporation that created the best known and most widely used credit score model in the U.S. Here is a percentage breakdown of a FICO score. 35% is derived from payment history, 30% of it is the debt ratio, 15% is the length of the credit history, 10% is the type or types of credit, and 10% comes from the number of credit inquiries. Subprime mortgage loans have a much higher rate of default than prime mortgage loans and are priced based on the risk assumed by the lender. As with other types of mortgages, various special loan features are often available with subprime mortgages. Although most of the loans that were considered subprime are a thing of the past or are now prohibited by law, they included loan features such as interest-only payments, which allow borrowers to pay only interest for a period of time, which is typically 5 to 10 years. Also included are pay option loans, usually with adjustable rates for which borrowers choose their monthly payment, whether it be the full payment, interest only, or a minimum payment, which may be lower than the payment required to reduce the balance of the loan. And also so-called hybrid mortgages with initial fixed rates that sooner or later convert to adjustable rates. Mortgage programs that target subprime borrowers through tailored marketing, underwriting standards, and risk selection should follow the applicable interagency guidance on subprime lending. Among other things, the subprime guidance discusses circumstances under which subprime lending can become predatory or abusive. Institutions designing non-traditional mortgage loans for subprime borrowers should pay particular attention to this guidance. It should also recognize that risk layering features in loans to subprime borrowers may significantly increase risk for both the institution and the borrower.